Welcome to Talking Supply Chain. In each episode, top supply chain industry professionals and the nation's top thought leaders join host Brian Strait and share their unique insights to help supply chain managers stay one step ahead of their competition. This is Talking Supply Chain. As we head into fall, economic uncertainty continues in the U.S. That uncertainty has been weighing on the freight markets, and various opinions have surfaced on whether the market is in a recession, coming out of one, or about to collapse entirely. Hello, and welcome to this episode of the Talking Supply Chain podcast. I'm your host, Brian Strait, and I'm joined today by an expert in freight that will hopefully help us sort out the current market conditions. I'd like to welcome Andy Dyer, CEO of AFS Logistics. Welcome to the show, Andy.
Good afternoon, Brian. Thank you for having me.
Great. I'm glad to hear. I'm always happy to get the state of the freight markets, if you will. A lot of our audience is very concerned with that, obviously, being in the supply chain. So excited to talk to you and get some questions answered here. Before we really get started, though, can you kind of tell the audience a little bit about yourself and AFS and what you guys are all about?
Sure. So let's talk a bit about AFS first. So AFS is a 42-year-old privately held non-asset-based provider. We have a focus within the transportation space, and really our job is to end freight cost uncertainty. It's are you paying the right amount? Are you getting the best rate, and are you planning and executing in order to optimize the outcomes that you want? And we've been doing this for 42 years. I joined the company 4.5 years ago, and delighted with that decision ever since.
Great. You guys work together with TD Cowen to produce a quarterly freight index called the TD Cowen AFS Freight Index. Easy enough. The latest release allowed, and a lot of our conversation is going to focus kind of around that release as the jumping off point for this discussion. So the latest release that just came out talks about the truckload rate per mile continuing to remain low. In fact, I think the Q3 number that you guys noted for line haul cost per shipment noted that it was the 7th consecutive quarter of year-over-year decline. So for shippers, that's good news, right? For the carriers, not so much. The index, though, is showing some hints that maybe that number has reached a floor, which I think, if I'm correct, is about 12 to 14% above the pre-pandemic levels of that.
That is in line. Yes, that is in line with our index. Yes.
Yeah. So can you talk a bit about what the impact of these rates are having on the market today, and whether there is any hope for improvement, I guess, from the carrier perspective, for the rest of this year and into 2025?
I unfortunately am not going to be a source of optimism for the carrier segment of the audience here, and that's not because of anything other than the facts in front of us. What's going to drive it? Everyone wants is some sort of demand side spark or catalyst, but there's absolutely no evidence of any kind that is on the horizon. Okay, so really what this means is, while we are, if you look at the graphs that we produce and that others are, because we're in line and directionally equal with them on that it's really going to be a supply side correction. We've started to see exits already over the past year, maybe 15 months. I wouldn't go so far as to say it's accelerating yet, meaning the exiting of capacity. But I honestly believe in the short term, it's going to have to be a supply side correction. It's going to drive freight rates in a carrier friendly direction. Okay. I don't think there's a lot of deterioration left, just because we're starting to get down to operating cost here. All right. And again, unless there's some introduction of efficiencies, which there's no evidence of that anytime in the near future, I think, again, we're going to see continue to bounce along the bottom until we see a supply side exit. The only thing that I will footnote that with is if there is some large demand surge. I used to be a defense contractor, and, global activity can drive large demand spikes inside the U.S. I mean, I'm old enough to remember we were fighting 2 wars simultaneously inside this century. And that drove a lot of production. And when we produce a lot and export a lot, because all this stuff was ultimately going out to theater, it produces demand. So my point there is, and that simultaneously with record low interest rates that had a booming construction market. I mean, there are a lot of things happening all at one time, in the first 15 years of this century. But it's going to take that kind of activity to drive a demand spike that's going to correct this. So that's why, I'm a bit more pessimistic and suggest that it's going to be supply side correction that's going to start driving rates up.
Yeah. And I think, as you mentioned, I mean, something happens globally. I mean, I've had a lot of conversations about geopolitical issues and concerns around the world with people, that's probably something that, as much as you might say, hey, I hope this happens, but it'll be good for my business, it's probably not something we really want to happen for our businesses,
No,
right? But
no, but the other thing, the other thing I'll tell you when I was hanging out in defense circles a lot, um, it's not always about the activity, it's about the uncertainty and the fear.
yeah,
So a lot of a lot of demand and such is driven out of uncertainty and fear and preparedness for the uncertainty. Now, again, so my point there is you can sometimes get some of this balloon without necessarily really bad things happening because nobody wants that.
right.
Okay. At the end of the day, we're all humans, and we want everybody to go to bed at night in the same condition that they woke up in.
Yeah. So, a different type of fear, for those of us who do holiday Christmas shopping, is we can't find our present. um, uh, Parcel rates. Want to get to parcel rates as part of that. So we are in the throes of the busy holiday season. Parcels now are ramping up and traveling all over the country as people look to get those items and shop online for the perfect gift. And carriers are moving things around to stores and things like that. Before we kind of kicked off this peak season, most of the big parcel carriers had announced peak surcharge increases for this year, which has become a pretty normal process on a year
Mhm.
every year.
Yep.
Your quarter three index, though, seem to be saying to me that there is an awful lot of discounting happening in the marketplace, though,
Mhm.
despite these surcharges. So, kind of what is going on in this parcel space right now?
So I think we're in a moment where both things can be true at the same time.
Mhm.
So the two large players in the U.S. market, and we all know who they are, have really been um, more pervasive in applying surcharges. They have been creating more surcharges to apply, and they've been increasing the rate per surcharge. Okay, so all this kind of non-line haul activity has been going up, 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 up. Of course, fuel's been going down, which mitigates that some. And then on top of that, because we are in somewhat of a demand low compared to pandemic, but not so much a demand low pre-pandemic, I'll get to that in a minute, people are clamoring for market share. So while they're making gains on surcharge, pervasiveness, application, and rate, they're giving up some of that gain in price discounting in order to either maintain market share or in some cases capture vulnerable pieces of market share from the other.
Mm.
Okay. So we got a lot of that going on. And so you're also seeing some and again, this is all supposition, just based on the data. But we also see maybe some exiting of some of the larger shipments into the LTL networks, because of all that surcharge activity. Okay. And here again, I think we're in a position where uh, the industry responded to, I would say, a generational demand spike. All right, which is we all know is COVID-19 that really got once we hit the trough in 20 when everybody went home, everyone started coming back from home and ordering even while they weren't home, all that drove demand up, 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 up. And people responded to that by building up capacity and also new entrants into the market, which again is why you're seeing truckload go through some of the same dynamics. So I think we are kind of resetting to more what the worldwide population needs and wants right now. So again, I think we have kind of an uplift in surcharge activity broadly, and then continued discounting in order to retain or capture vulnerable market share.
Yep. So, I mean, there are a lot of different surcharges out there. Are we seeing the fuel surcharge is another one, and you mentioned, and people know diesel prices have dropped this year.
Yes.
What's the situation there? I think your index noted that UPS and FedEx's fuel surcharge is up 77% compared to 2021
Well,
levels.
again,
But
that's back to the concept of being more, I'm just going to use a polite word, assertive
yeah,
in surcharges, all kinds.
okay.
Okay. And fuel having to be one of them. So you increase the rate, even though on a lower price basis, you can still get a bigger yield.
So then I guess my question, which in the broader sense of this, is simply that if we have these surcharges galore going on now, whether it's fuel, whatever your surcharge is, um, are shippers actually paying less than what they were before, despite these surcharges increases? I mean, is that
No,
what's really happening here?
no, no, no. There's no evidence that they're actually paying less.
Yeah.
What I would argue is that the environment in this case because of that surcharge activity, is actually favoring the carriers. And we know, again, we know who we're talking about here.
Yeah.
Largely because as a shipper, depending on the tools and insights available to me as a shipper, I may or may not be able to get my arms around what's driving my cost.
Mhm.
So what's happening is it's becoming increasingly more difficult for the buyer of services to understand all the dynamics of the actual services consumed and ultimately the cost expensed. Okay. So it is, and so it does make for, again, if you're a buyer of these types of services, a more complex environment to navigate.
Yep. So just make it complex and we'll figure it out. And the carriers will make their money still.
Well, you know what? I will say this, I have a lots of opinions, but one of them I think is polite and broadly applicable. It's okay for everybody to make money. In fact, I believe that the best relationships between trading partners,
Yes.
regardless of industry or interaction, is one where the trading partners both win.
Yep.
And they don't always win an equal share necessarily, but they both have to win. And so I think it's okay for people to make money. I'm a good capitalist. That's my job, make rich people richer, right? And then, by the way, service my customers and delight them with great service. But it's okay for everybody to make money. It really is.
And that goes to the bigger point of what happens in downturns, right? I mean, the companies that my view on this, the companies that are not out to stick it to the other one, the other partner in the relationship,
Hmm.
when the downturn happens, they're both able to weather it a little bit better, right? Because they can trust the other one, that they're not trying to
Yeah.
gouge them in any way at this point.
No, and I can speak to that in a very short story from my past. And this is first decade of this century. I had a very strong relationship with a truckload provider. And, 1 year last 3 calendar days of December, we were working with an HPC brand that was highly reliant on New Year's as one of their biggest moments in their product category. The category doesn't matter.
Yeah.
And we woke up at a warehouse in Memphis, Tennessee, that 3 days before the end of the year and realized, oh my God, and this is not AFS, I'll be very clear, but we found that 450 orders that had been misprocessed. So I had to call this guy and actually good friend still to this day. And I said, Bud, um, I need you to drop 450 trucks in Memphis in 48 hours. Now, at the time, that was a tall, tall order, right? And he did it.
Yeah.
And of course, there was some horse trading about, if he had to give up somebody else's freight, what was I going to do to make it worth him and his company's while? But that was all fair. All right.
Yeah.
And then, fast forward, say 5, 6, 7 months from that period, but inside, quite literally the very next calendar year, he called me and said, Andy, I need you to return the favor. I said, what happened? He said, well, we had a big customer, get ready for a big event. I'll spare you the reasons why, but that event tanked. And I now have, 325 trucks stuck in this basic area. The area doesn't matter. I need your help. So we went through the same auction in reverse. Hey,
Yep.
I can, not use blue trucks and use your green trucks or whatever, but I'm going to need some consideration here. And it is, you're absolutely right, Brian. It's that type of trust that gets people through those tough times.
Yeah. So, speaking of trust, this goes to it. We hear this a lot. I mean, there's a lot of talk out there about the balance of power and leverage. The shipper's leverage versus the carrier's leverage.
Mhm.
From in the parcel space, do you see any shift going on there at all? As we head into 2025, is there either side that maybe is getting a little bit better, a little more pricing power heading into 2025?
Yeah, I'm not so sure that I would say that one versus the other in a predominant way, but
Yeah.
I can tell you from our direct AFS experience that we've helped. So, because we have a large uh, talent pool that understands parcel and parcel contracts and whatnot inside the organization, and we've helped some customers, buyers of services, capitalize on some significant rate improvements. In many cases with minimal to no shift in share of business they give to each brand. Okay. And that speaks back to what we were talking about in the beginning. All this uncertainty of demand, despite all the greatness and surcharge activity, is forcing discounting to retain market share I'm not going to say any expense, but at very forward-leaning posture that they had. So I would say in the moment, there is definitely some buyer strength available. But I'll also tell you, Brian, these things are all so fragile and they turn so quickly. Okay. But I would say you see some modest buyer advantage in today's space.
Yeah. And I think I got a question later. I want to ask you about kind of the broader space on that on contracts and whatnot, and we'll get to that in a few minutes. But I want to touch quickly though on the less than truckload space.
Sure.
So the LTL space, there's been a lot of activity there the last couple of years for a space that doesn't get a lot of attention typically.
Yeah.
And I think it kind of started with the bankruptcy of Yellow Freight a couple of years ago, and there was a lot of doom and gloom. The whole market's going to collapse, et cetera. And that didn't really happen, right? I mean, kind of the freight kind of got absorbed into the network. And we've kind of continued along the way. But your index is indicating that there has been a continuing decline in the weight per shipment and the cost per
Mhm.
shipment's down a little bit as well. I think
Yep.
0.6% quarter over quarter.
Mhm.
So can you explain what those mean to our audience? And is there anything positive that's coming out of this for the carrier on the carrier side?
So what we're seeing is just that. You're right. We're seeing, generally speaking, a lower weight per shipment. I mean, weight per shipment with a W, weight per shipment, which typically drives, while it drives a higher rate per pound, it drives a lower absolute cost per shipment, right? If you ship 300 pounds of stuff versus 3,000 pounds of stuff, you generally pay less in absolute dollars. Okay. And a couple of things are going on. Post-pandemic, but pre-YRC demise, there was a significant push by the LTLs because they were getting abused. If you remember the wild truckload market that we lived through in 21 and into 22, the LTLs were getting abused because the truckload carriers were, in some cases, on the spot market able to get $8 and $9 a mile for a truck. And if you know anything about truckload pricing in the US, that is unheard of. Okay. It's like buying US truckload in yen. Okay. It's just unheard of. So because of that, shippers were basically stuffing these or what would be unnaturally sized shipments into the LTL networks. Okay. So in response to that, the LTLs exercised, I think, very strong pricing discipline. And they imposed a lot of surcharges and other types of things to make it prohibitively expensive to abuse them. Okay, and make them a truckload carrier when they're not. Okay, so that, and then of course we saw the downturn in demand, collapse in truckload pricing. So between the pricing discipline and the softness in demand and the availability of truckload capacity, all that large freight kind of started to go back where it belonged into full trucks or near full trucks. Meanwhile, you see all this activity going on with 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 the parcel surcharge activity. And that drives, again, some things that normally would have stayed at a parcel network started driving into the LTL networks. Now, that wasn't as penalizing to the LTLs because that's what they're built to do. Okay. Now, mind you, of course, they still had to have pricing discipline on their mins and whatnot, because in today's world, no LTL wants to move a shipment for $27, right? They want to move it for $127. So that's kind of driving some of that. We're also seeing the data suggests some shortening in length of haul in some instances. Um, and if you suppose, like we have, that is a function of regionalization of inventories and regionalization of distribution networks, typically, as a buyer of things, I can order in smaller quantities and respect my inventory carrying costs if I know getting that shipment of things is 2 days away as opposed to 2 weeks or 2 months away.
Yep. Yep. So I mean, I agree. I mean, the LTLs for whatever reason, they for years they've been very good about their pricing and the
Mhm.
discipline in that market. I think more so than some of the other segments of the industry have been. Um, so they've done pretty good. Want to shift kind of to the overall freight market, and you just touched on LTL a little bit. Want to ask you, and I think I know where your answer is going to go on this based on some other things you've suggested so far. There are people that are suggesting, hey, 2025 is going to be a good year. Others say, well, it might be later in 2025. I was at a conference recently, and I was talking to somebody from a company, and we got into this discussion about next year, and he asked me what I thought, and I asked him what he thought. And his answer to me, I thought was very kind of comical in some ways, but I think so realistic these days. And he says, whenever I have this discussion, the answer is always in about 2 quarters, and it's been the same thing for 2 years, right?
No, no, but that is consistent with, I think, most people's experience. I agree.
Yeah. So, is there anything in your data that you guys are collecting that is indicating how the market may move in 2025?
Well, again, at a broad macro level, again, I think we're going to see some bouncing along the bottom. You've read our indexes. We're predicting next quarter some modest upticks in some areas, but I think that's more a function of being at the bottom than
Okay.
of a demand spike. I mean, again, if you go my earlier comment that we really are, particularly in the truckload space, we really are flirting with operating cost at some of these pricing levels. Okay. And let's face it, if you're an investor, whether you're a large publicly traded company or a privately held company, maybe sole proprietor, where are you going to put your money? You're not going to put it in a bank account for zero,
Yeah.
right? Let alone take on the risk of operating. All right, so again, I think we'll see some modest uptick, again, just as kind of a bounce along the bottom. But I don't see anything seismic that is going to produce an industry-wide um, uh, bounce
Yeah.
for the capacity.
Barring some outside influence that
Again,
triggers
all
something.
these
Yeah.
things can happen.
Yeah.
Exactly.
Yeah. Want to ask you about a couple of other topics in the space, since you guys obviously work with a lot of people, talk to a lot of people, and kind of get some sense as to what the market is kind of talking about here. And the first one is the longshoreman situation at the ports, the U.S. ports, East Coast, Gulf Coast ports. I know we just had a 3-day strike, and that got settled, thankfully, right?
Mhm.
Didn't create any big
Yeah.
disruptions at the moment, but
Sure.
there is another deadline on that. I think people have just focused on, hey, the strike's over. There was a mid-January deadline to get the contract actually done. There is no contract yet, right? It's just kind of the framework
Correct.
of an agreement.
Yeah, it's basically an
Um,
extension agreement, more, kind of think of it in simple terms, right?
Yeah. So I know that port automation is a big factor in this contract, and I don't know where the union doesn't want it, obviously,
Yeah.
et cetera. So, I mean, my guess is that eventually they'll come to some kind of agreement, but are you hearing anything in the market? Is there any concern that while everything is okay now, that we may be sitting here in January going through the same thing all over again with the ports?
Well, there is very real concern there. There absolutely is. And I think, for those who were not forward looking, this time last year, because these contracts are all publicly available documents, essentially, right? So
Yeah.
we all know these dates. They're not surprises,
Yeah.
right? I think a lot of people who didn't start paying attention until the press said, hey, guess what, folks? Potential crisis is coming. Oh, by the way, it's getting very real with each passing week. I think it taught a lot of people, I better wake up and pay attention now. And it really was a call to preparedness.
Hmm.
Okay. So do I think there's risk? Absolutely. I do think with the passing of the US federal election cycle, there will be a little less politicization to all of this. Okay. Because by that time we'll know who's in charge, right? And people will kind of know who has their back and who doesn't, which I think may settle some of it. All right, but there's still always a great uncertainty. And until there is blue ink on the bottom of a piece of paper, there is still uncertainty.
Yeah.
Right. So I think, my advice to customers and just industry at large, prepare now. If you wait till the same cycle time from this past one where you start paying attention 10 days early, it's too late. You're done. You are now at the mercy of events.
Yep. Yep. I mean, look, if you're concerned about January, you better start preparing now.
Exactly.
So,
Exactly. And
yeah.
again, but I think with the advent of the election cycle, that will dampen some of the volatility because again, I think, and we can all have our political opinions here, but it is safe to say that one administration versus the other is going to have a very different world of view on how to manage labor markets and regulate industries. And again, that'll give either side maybe kind of a different thought on the stability of their platform. Okay.
Yeah. Yeah. The other area I want to ask you about, and this is an area that people talk about all the time, right? And that's Mexico. And we've seen a lot of investment in Mexico. A lot of shippers diversifying supply chains, bringing goods out of Mexico instead of other places from Asia, for instance.
Right.
But there is still some indication there's still a lot of factories that are not fully operational in Mexico yet. They're not either haven't been built, they're in this planning stages, or they're just not running at full capacity yet. Um, Once those actually happen, I think last time it was like probably 2 to 4 years, I think probably time frame now where some of this stuff, and we could see a lot more cross-border freight coming across Mexico at that point from these facilities. Are you seeing the market start to adjust in preparation for what probably is going to continue to grow down in Mexico?
Absolutely. There is kind of the US, there's a lot of, US freight center of gravity is moving south. Okay.
Yep.
It just plain is. And you're right, these are long-term changes. COVID scared the pants off a lot of people, and for good reason. It showed the vulnerability of long lead time, long transit time, long distance JIT strategies.
Hmm.
It exposed that weakness vividly. Okay. So yeah, people are starting to nearshore, but not only you have to go build capacity or buy into capacity, you've also got to you've got to have all your first destination, your tier ones, able to support you too, right? If you just because you're building a thing in Mexico, if your supply stays still in Vietnam, you're still exposed, right? So it takes a while for all that stuff to shift. Um, but yes, I think most people in my chair across the industry are definitely going to feel a heavier weighting and center of gravity of the U.S. freight markets moving southward in the country.
Yep.
Yes.
Yep. Yeah, I think we're probably going to see a lot of change in the next few years with the truck lanes, right? The truck routes that are being run in this country because of that.
Mhm. Yeah, it'll be
And
really interesting. What I think will be really interesting, and I'm not going to speculate here on the what's going to happen, but I will speculate on the moment that will happen, which is as that cross-border traffic continues to escalate, and not by single digits. I mean, we're talking over 3, 4, 5 years, significant double-digit growth across the border. It's going to force regulatory change.
yep.
I mean, I was on the border as recently as 2.5 months ago. Which crossing doesn't matter, but the pictures do not do the experience justice when you are there in a passenger car along a line of 53102s that quite literally appears to go past the horizon.
Yeah.
The visual scale is staggering.
Yeah, I we have a woman who writes for us, Rosemary Coates. Some of you out there may know her. She's from the Reshoring Institute
Mhm.
and is an expert on this sort of stuff. And she writes a monthly column for us and a podcast as well. She does the Frictionless Supply Chain podcast, um, that we host. But she recently made a trip, I don't know, 6 months ago, 8 months ago, down to the border, Tijuana area,
Mhm.
and she came back and she was telling me that it's amazing when you just sit there and watch how many trucks are going through, and quite honestly how efficient they are at getting them through,
They are,
with
but the
the
lines
amount.
are huge. And
Yeah.
industry's not going to stand for it.
Yeah.
Whether it's the carrier industry, the buying industry, and people buying all this stuff, right? Industry's not going to stand for it. And, you know, again, I don't know how it's going to resolve itself, but I have to imagine there's going to have to be some form of regulatory change and potentially bilateral trade agreements.
Yeah.
Change.
Yeah.
Okay.
And another whole podcast on that
Oh
topic
yeah,
probably,
yeah,
for
that's a
sure.
different story for a different
Yeah.
day.
Yeah.
But I do predict
But
that moment is coming. I do.
yeah. I want to get to two other quick things for us before we finish up here. One is contracts in the space. Typically, when we see rates really low, shippers want to lock in longer term contracts. Vice versa, when rates are high, carriers want to lock in a longer term contract with the shippers. Are you seeing any kind of movement on the contract front as far as our shippers trying to get longer terms right now, and our carriers willing to discuss that?
It's all compared to your baseline. Okay. So are we seeing contractual term in period of time? Okay.
Mhm.
Not in T's and C's, but in the contractual period of time, it is incrementally moving forward from the spike of post-COVID recovery, where you couldn't even get a contract. I mean, there are different numbers out there, but it was overwhelming majority of transportation was moved in the spot market. Um, So you're seeing it incrementally move out, but it's not the same as you would have seen quite literally pre-pandemic, where by and large, you could shippers and carriers would work together. They'd figure out roughly 12-month deals, and we all had different experiences in those, but by and large, people honored them. right?
Yeah.
Because what volatility wasn't there. So, people are still a little scared. The carriers, again, they're incrementally moving out. So instead of contracts being days and weeks long, now they're months long. But kind of these, pre-pandemic, in some cases, multi-year with escalation terms and whatnot, you're not seeing those yet.
Okay. All right. And the final question, this pertains to your business really well. We've seen a lot of, or not a lot of, we've seen some larger shippers in recent years kind of build their own logistics networks. And kind of bypass that 3PL marketplace.
Yeah.
Amazon obviously is an example of that. Walmart's been doing a little bit more of this. They just made their recently their Go Local delivery service available to outside firms for last mile delivery services. So is that a trend that you see continuing? And what does the traditional 3PL do to remain competitive in the space in the years to come?
So two-part question. So first part, yes, I do see that continuing. In fact, I see it accelerate.
Mhm.
Okay. Because as you reach scale, you find it's easier to, it's financially more viable to build versus buy. Okay. All kinds of reasons when we don't have to go into that. But that is indeed true. Now, as you scale and build your own network, you're inherently going to have some inefficiencies in your network because no network is 100% efficient, which means they absolutely have to go to outside demand in order to mitigate internal deficiencies. Okay, or inefficiencies is probably a better way to put that. So I do see that continuing to happen.
Mhm.
Okay, Amazon was the first, and back to our parcel discussion. I'm not inside those boardrooms in Memphis and Alpharetta, but I have a feeling I know what they're talking about. Okay, so because they know it's coming.
Yeah.
Okay, so yes, I do see that happening. One, two, what does it do for 3PLs? Well, my opinion, I really think we're going to see further migration to the poles, meaning of the industry, which is you're going to find that the really big ones are going to satisfy, um, kind of the Fortune 500 set. Okay.
Mhm.
There's going to be a lot of very intense competition there and a lot of price competition that's going to until until there's only one left standing or close by, margins and prices are going to get very, very thin. Okay. But if you take the strategy that we do, which is serve the underserved, okay, then you can produce an extremely valuable service and financial and performance package for a customer where again they save money, I make money, everybody wins. Okay,
Yep.
so I do think we'll see that, and I think it's really the folks in the middle of the provider side that are going to be challenged because they're going to be too expensive to handle a little guy because they got their SG&A overhead, but they're not going to be big enough to challenge the big guys because they don't have the buy leverage.
Yeah.
Okay, and they're going to find themselves, I think, in a really tough spot.
Yeah. Well, thank you, Andy. We are really out of time. So thank you so much for your time today. If people want to get in touch with AFS Logistics, what's the best way for them to do that?
Just go, well, you can just go to afs.net and we have a contact us. We have a very small marketing group. What I mean by that is you get attention. Okay. So as they come in, go. And then, yeah, and we are highly responsive to those inquiries.
Great. Well, thank you again so much for your time. I want to thank my guest today, Andy Dyer, of CEO of AFS Logistics, for sharing his thoughts and insights in the current freight market. And a special thank you to all of you out there that took time out of your day to listen to us today. We greatly appreciate it. A new episode of Talking Supply Chain comes out each Thursday. You can find it on scmr.com or wherever you get your podcasts. So be sure to subscribe so you never miss an episode. Till next time, this is Brian Straight, and you have been listening to Talking Supply Chain. Talking Supply Chain is produced by Supply Chain Management Review and Peerless Media. You can find it on scmr.com, supplychain247.com, iTunes, Google Podcasts, or wherever you find your podcasts. For more information on this topic or to sign up for our weekly newsletter, a print or a digital subscription to our publication, visit scmr.com. We hope you will join us for our next episode. For Supply Chain Management Review, I'm Brian Straight, and thank you for listening.